Hello, fellow Repo Capitals. Hope you're well. So we got big news in the repo market. That's right. Everybody remembers September 2019 repo madness, where the repo rate went up to almost 10%, maybe even a little higher than 10%. Well, we're starting to see red flags again. And it's not just in the repo market, it's in other markets as well. So when you put everything together, all the pieces of the puzzle, you see that the risks in the system are starting to increase substantially. All right, let's first and foremost go over to what is happening in repo. And I'm using SOFR. So we're going to look at the delta between SOFR and we'll do SOFR and Fed funds rate. Now, what's really kind of bizarre is, I don't know if you guys have experienced this today, but I guess Amazon, a lot of their servers or cloud servers or something like that are down. So it's definitely impacting the Fred website, because I couldn't pull up any charts on Fred at all. I just kept getting like an error message. So hopefully they'll have that fixed soon. But let's go over to micro. And we can see this yellow line is what we really want to pay attention to. So let me zoom in and let's check out. Whoa. Time out here. Okay, that looks like it's as far as it's going to let me go. So let's look at that yellow line. Now, what we want to do is we want to, once we see the yellow line, we want to focus on the difference or the spread between the yellow line and the red line, or maybe it's orange. The orange is the effective Fed funds rate. So the overnight rate of interbank lending. Now, that is going to be different than the interest rate the Fed is paying on reserves, because there's parties and counterparties involved there that don't get paid on their reserves. So they're just trying to pocket a spread over reverse repo. So reverse repo right now is 4%. So that's why you see the effective funds rate slightly below actually the interest paid on reserves. But we're getting into the nitty gritty of the plumbing there. It's really not necessary for this video. But what is necessary is that you focus on the delta, or you notice the delta between the yellow line and the orange line. So now it does spike periodically, but usually it's going to spike at the end of the month. And this is for the variety of reasons. And I'm not going to get into it right here, but it usually, so that's not atypical. That's the point. But now we did have a big spike right here, and that was not at the end of the month. Now, I don't know if that was maybe a tax issue, September 15th. So maybe that's when corporate taxes are due. I'm just thinking out loud. But what's really wild is we have so this spike that you're seeing right here between the spread increase, the spike in the yellow line, is not at the end of the month. There's nothing that explains it. That's really the bottom line. So a lot of people, what they'll do is they'll point to the amount of QT that the Fed is doing. And I'll try to pull up a Fed chart and see, but you guys know that the Fed was doing QE. So the size of their balance sheet, the amount of bank reserves, and the system goes up. But for the past 2.5, maybe 3 years, they've been doing quantitative tightening. So the size of their balance sheet is decreasing, and they're allowing a lot of those assets that they held, mostly mortgage-backed securities, to roll off their balance sheet when they mature. So what you're seeing right here, a lot of people, most people would argue that, there's just not enough liquidity in the system. Because what's happening here is the yellow line represents the SOFR rate. So that's overnight lending in repo that is collateralized. Those are secured loans. Where this orange line, that represents unsecured, this kind of interbank lending, but the GSEs are included in that as well. So when you see this yellow line really start to spike up, it's one of two things. Either it's a lack of liquidity, meaning that the banks just don't have any cash. Like there's no more cash. And so since there's no more cash to lend to people, even at secured rates, then the rate goes up. That's what 99% of the people focus on. Now, I have always looked at things much different, and I did this way back in the repo spike during 2019. Is I always said, yeah, I don't know if it's a lack of cash. I mean, at the end of the day, the banks create cash, they create liquidity, and they don't necessarily need bank reserves to go ahead and settle interbank or really do anything. So, what's really going on here? And you think about it a few steps further, and you're like, well, wait a minute. Maybe it's not that they don't have any cash. It's that the counterparty risk is increasing, and they need to be paid more to go ahead and lend to whatever entity they're lending to, even though that entity is giving them collateral. Because I don't know, maybe in the past week, we've seen a lot of issues with collateral. Tricolor, First Brands, and Zion Bank, a lot of these regional banks. And I'm going to be going over that in just a moment. So let's think about this. If you're a lender in repo and you're seeing all of these collateral issues in the banking system, and you're seeing all of these red flags, and you're like, Jamie Dimon's talking about cockroaches. Yeah, that makes a lot of sense. And you know that when you see smoke, it usually means there's fire. Well, then, even though you have the cash to lend, you're going to be like, oh, I don't know. I need a little bit more interest. I need a few bips more to compensate for what I think is risk in the system. And so this, for me, is a better explanation than what you hear in the mainstream media that, oh, boy, I guess we're all out of money. There's no more cash. There's no more liquidity. The Fed needs to do QE again. So there's bank reserves, because this is just showing you that there's not enough bank reserves in the system. Or what that means is there's not enough liquidity. And what that completely ignores is the banks create liquidity themselves. It's all based on risk. So if the risk is very low, I don't care how many bank reserves are in the system. The banks are going to create liquidity, and they're going to create credit, and they're going to lend into the repo market because they don't need anything to lend. They just need it for it to make sense as far as risk reward. So that's where I have I think a much different view than the mainstream and most of the people on social media, where they just have this idea, this framework that the banks don't create money. The banks just they can only lend what they receive. To me, it's like, I don't know. It's weird to think of banks that way, because you're thinking of them in terms of like a goldsmith in the 1600s. Like it's somehow, but even the goldsmiths could create money in the form of receipts. And I don't know. It's not even fractional reserve lending. It's the banks don't need any reserves. They create a loan that creates quote unquote money, that creates dollars, that creates commercial bank deposit liabilities, and they have an offsetting asset, which is the loan. And if they have to transfer that, they need interbank settlement. Great. They do that on credit as well. They don't need bank reserves to do that. But anyway, so when I see this, what I see as if it's an anomaly as far as the timing is increased risk, which if you think about what happened last week, that makes sense, right? But it's not just this market. Let's go over to the oil market. Look at this. $57. Oil, $57. What does this tell you? To me, this is demand just getting smashed, or the expectations for demand going down. Well, if expectations for demand for oil are going down, what does that tell you about the projections or the expectations for the overall economy? I mean, energy is the economy. So if energy prices are going like this, then that tells you that likely the expectations for the economy are doing the exact same thing. Do we have a supply glut, as CNBC says? Maybe. Is it oversupplied, or is the demand just too low and the demand declining? I think it's probably more so On the demand side, especially when you look at what's happening with the labor market, as an example, you look at what's happening with repo, and the kind of a head scratcher here. It's like, why are we getting that spread? Now, of course, it's not up where it was, not even close to 2019, but it's starting to become, it's a red flag, even though it's come down substantially, as you saw in that chart. Because what we're doing here is we can't just look at SOFR or what's happening in repo. You have to look at this in addition to everything else. And you can't just look at it as an isolated indicator. So unless it goes to 10%, then you can definitely look at it as an isolated indicator. But we're not there right now. It's the combination of all of these indicators. And so a lot of people recently, as you guys know, are talking about the debasement trade, the debasement trade, the debasement trade. Look, if the price of gold skyrocketing, which it obviously is, was a result of the debasement trade, oil would not be trading at $57. Like, there's no way. There's no way. And look at the chart. It's not like it's in an uptrend. It's coming from the lows. I mean, look at this. Look at this 1 year chart. It's terrible. In fact, I didn't even realize this. The low of the last 12 months was $58. And we've gone right through that resistance level, trading under at 57.48. So, I mean, let's zoom out to a 5-year chart. I mean, look at that. From this point, when it was 120, I mean, it's just, this is a terrible chart. And just based on this chart, I mean, I don't know. I mean, it could go into the 40s. So why is that? Is that just because the world is producing so much oil? No, because OPEC would simply say, cut the taps, baby. We don't need it at 57. And by the way, you know, what's that doing to American producers? I'm not saying that they produce it higher than 57, but things are getting a little tight here as far as the margins. That's for sure. So, you know, this trades, let's say, down to 50 or even in the 40s. What does that tell you about demand? What does that tell you about demand? And now let's go over to interest rates. And here's another reason why you know that the price of gold, going up has nothing to do with the debasement trade. Now, is the dollar losing value? Yes, but it's not doing anything as far as unprecedented. And the reason people are buying gold or Bitcoin or whatever, they're not really buying Bitcoin, but just more so gold and silver, it's not because of a debasement trade. Again, or else you would not see oil going down to 57 and maybe even into a 4 handle, 40. And then look at what's happening with bonds. In fact, it's down just since I refreshed about 5 minutes ago. So the 10-year treasury trading under 4%. Look, if this was a debasement trade, then you would not have bonds. And people always say, oh, it's about issuance, Now, look at the entire curve. Look at the entire curve. There's no way the curve would look like this or be under Fed funds, a lot of the curve. And there's no way you'd have the 2-year trading at 3.47, something like that, with the concern over inflation accelerating like the 1970s. Like this is not what would happen. And this is a 1-year chart. Let's look at a 3-year chart. Oh, they don't have it here. But if you look at year to date, we're down, obviously, on the year. And down big. I mean, down 60 basis points. Remember just 2 months ago when the whole narrative was interest rates are going up. Well, interest rates are going up. And even though they were going down, and we talked about that on this channel all the time. Remember, interest rates were going down, but yet everyone on social media was saying, well, you know, I mean, interest rates are going up. Interest rates are going up. The foreigners are dumping treasuries. We've got these deficits. The debt is exploding higher, and interest rates are just they're out of control. The bond market is telling you that they're rejecting these deficits. And they kept saying that over and over and over again while interest rates were literally going down. And you're like, what are you talking about? And they're like, oh, well, they went up right here. They went up right here during retardation day. but then they just kept going down, down, down from there. And people just extract, or they just take what happened the 2 weeks after retardation day and just extrapolate that indefinitely into the future, even though interest rates have been doing the complete opposite. So the point here is that interest rates are a reflection of the economy. They don't control the economy. So what the 10-year Treasury is telling you this year is that the expectations for nominal GDP are going down. Now, that doesn't mean that you have a crisis or a depression or a GFC or anything like that. But the expectations for nominal GDP are going down. So you got the 10-year, and by the way, the Fed funds rate is roughly 4%. So you got the Fed funds at 4%. You got the 10-year trading under that. You've got a good portion of the curve that's inverted. You've got the 2-year Treasury trading at 50 basis points plus under Fed funds. And then you have the story right here. The tide went out, how a string of bad loans has bank investors hunting for hidden risks. So now let's go over this, and we're going to tie this back to what's happening in repo. But before we did that, I just wanted to show you the price action in some of these other markets that would back up kind of that thesis or that framework for looking at SOFR and repo through the lens of risk as opposed to the lens of just, oh, the system needs more bank reserves. The banks just don't have any money to lend, and that's why rates are going up. If you say that out loud, it's like, it doesn't even make sense. Like the banks don't have enough money to lend. What? The banks make money. The banks create the money. The banks lend money or currency, whatever you want to call it. They lend it into existence. So how can they not have enough? Like what? All right, let's get back to this article here. The tide went out. How a string of bad loans has bank investors hunting for hidden risks. It's not just bank investors, it's other banks. And it's obviously people that are lending or entities that are lending into repo. The risks are going up. The risks are going up. So if the risks are going up and you are lending into repo, even though it's collateralized, okay, fine. You're going to charge a higher interest rate, aren't you? This is common sense. Even if you have the money, you're still going to charge a higher interest rate. Why? Risks have gone up. And it's not just risks in the economy, it's risks in the banking system, in the financial economy, with the financial institutions. Now, what I want to get down to here, I've highlighted some of this. So we talked about this with Zion, and that name should ring a bell because they're one of the banks that had issues in 2023, March, Silicon Valley Bank. So Wednesday, they disclosed that nearly a wipeout of 60 million in loans after finding apparent misrepresentations from borrowers. Okay, so that's missing the point. That is really missing the point. Because what was the misrepresentation from the borrower? It's that the collateral they pledged was only pledged to Zion. That was the misrepresentation. You see, the collateral was pledged to a lot of different banks, not just Zion. So if Zion wants to, for lack of a better term, foreclose and get that property back that they lent on, and by the way, a lot of this was for commercial real estate. So if they want to foreclose because they're not getting paid back and they want to take that asset to liquidate it so they can get their money back, there's no asset because that asset was pledged to 5 other banks. and the 5 other banks have already tried to foreclose on that entity and try to sell that underlying asset to get their money back. And guess what, Zion? You're number 6 in line. So take a number. I mean, that's what's going on here. So think about that. Obviously, that's fraudulent. But why is it all of a sudden you see all of this fraud? And by the way, it's happening with Western Alliance here as well, that said they had sued the same borrower, commercial real estate, a firm called Cantor, for alleged fraud. And the fraud, again, was misrepresenting the collateral. They pledged the collateral to multiple entities. And obviously, they ain't supposed to do that. But think about, why are they doing that? Is it just that all of a sudden fraud became more popular? Yes. But so I should say that another way. Is it just because people all of a sudden became more greedy? No. Is it because what happened is all of a sudden the tide is in, the tide is very high, so you can swim naked for as long as you want. In other words, you can pledge collateral to multiple entities, and it doesn't really matter because the tide has been in for so long. The economy is going to grow. You're going to get paid back. And sure, you're pledging the same piece of collateral to 10 different banks, but who cares? Because they're never going to have to foreclose because you're easily going to be able to pay all this money back because the economy is doing so great. The Fed's got your back. Everyone's flushed with stimmies. Demand is higher, blah, 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 blah. The whole narrative that we've heard, it was strong and resilient. Well, if the economy is strong and resilient, well, maybe you can just take out that collateral and kind of rehypothecate it a little bit because you're not going to need the collateral because the economy is strong and resilient. And see, you get this mindset, and then it's like prior to the GFC. It's like, why are these banks doing it? Because everyone else was doing it. And if you didn't do it, then you wouldn't keep up with all the other banks and you'd lose business. So you're like, yeah, I really don't want to rehypothecate this collateral. I don't want to do something illegal, at the very least, gray area. But all my competitors are doing it. So I don't have a choice. I'm going to do it as well. And this is, and you kind of rationalize as to why this is a good idea. But it's not just these guys doing it. It's a lot of different entities. And therefore, you're starting to see smoke. The financial institutions that are lending into repo understand that where there's smoke, there's usually fire. So what are they going to do? They're going to increase the amount that they charge to a borrower in repo, even though it's a secured loan. Let's keep going here. Concerns over credit quality had been simmering for weeks. It's not just credit quality. Again, it goes back to that collateral. It goes back to the collateral. And by the way, if the perceived counterparty risk is increasing, then you're going to require more collateral. And so what's that going to do? Well, that means the collateral that you need is treasuries. So what you would expect in that type of environment is for treasury yields to do what? That's right, go down. See, it all starts to make sense. It all starts to make sense once you understand kind of how the financial plumbing works, and once you understand how banks really work. And it all goes back to understanding the commercial banking system, understanding the monetary system. It's like taking an economic red pill, kind of. Okay, so JP Morgan, they said the biggest banks reported, and looks like they had 170 million loss tied to subprime lender. For JP Morgan, that's a rounding error. I mean, they don't even notice that. But it's not about what they lose. It's about what those tell you about what's happening in the financial system. So this guy is talking about Jamie Dimon's comments really resonated with people who were like, oh man, the tide went out a little bit. Right. But my point is, and I just talked about this in a whiteboard video, is if the tide is going out, you think it's just going to stop? Like, why would the tide just stop now? Likely the tide is going to keep going out. Why is that? Because you're starting to see money get tight. And it's not because of QE or QT. It's because of perceived counterparty risk. And so if you have an environment where the economy is starting to deteriorate, where you're starting to see bad loans, you're starting to see the tide go out, which creates a lack of liquidity, and that liquidity is needed for the economic machine to continue, or the financial economic machine to continue, then it's going to freeze up more. It's going to cause more problems. It's going to cause more blowups in balance sheets. It's going to cause more of this fraud to be exposed, which is going to make the tide go out even more. What are NDFIs? They're non-depository financial institutions. So this is private credit. This is shadow banking. And I was going over this on a whiteboard video, but now CNBC is saying the exact same thing here. The episode cast a spotlight on fast-growing category of loans. Okay, so it was regional, global investment banks alike. Okay, we got it. Rules put into place in 2008 financial crisis discouraged regulated banks from making many types of loans. So, man, this goes back to so many points we make on this channel. And it's what I always say is that you can create any regulation you want. The banks are going to figure out a way around it. That's why when anyone always, they bring up Basel III or something like that. Well, George, it's true that the banks can create their own money and expand their balance sheet, but they're not going to because of Basel III. I mean, the Fed won't let them do that. And I'm like, come on, are we really that naive? Honestly, are we really that naive to think that the Fed is going to have some regulation and the banks are going to be like, oh my gosh, I could make massive amounts of money here, but oh, darn it, the Fed's just that regulation. I just can't get around it. No, what the bank's going to do, they're going to say, okay, this regulation here. How do we get around it? Oh, easy. Bam, 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 bam. Done. It's the exact same thing they did with the reserve requirements. They never paid any attention to reserve requirements. The Fed even acknowledged that those reserve requirements that we had prior to 2020, they were a nothing burger. They're like just kabuki theater. It was just they acknowledged this. And why they didn't get rid of the rule, I have no idea. But they just wanted to pretend as though they were somehow constraining the banks when the banks just set up sweep accounts. Like, yeah, reserve requirement. Good one. It's the exact same thing. So I don't know this definitively because I'm not a banker, but why would it be any different with Basel III? Why? The bankers just found religion? Of course not. And this is another perfect example right here. The Fed put rules into place after the 2008 financial crisis, discouraged regulatory banks from making many of these loans. So again, you think the banksters are going to be like, oh, you got me. You got me. We could make billions of dollars on this stuff, but darn it, we can't anymore because the Fed set up this rule. Boo-hoo-hoo. No, they're going to say, fine, we'll just lend to a shadow bank. And then the shadow bank can lend to the subprime auto. Or the shadow bank can lend to First Brands. The shadow bank can lend to Tricolor. The shadow bank can lend to the commercial real estate company. And on my whiteboard video, I called it Garbage Corporation with a triple F rating. So yeah, technically the banks can't lend to Garbage Corporation, but they're just going to set up an entity to lend. And then they're just going to act as an intermediary. So you look at their balance sheet. Oh, yep. Look, rules right here. Check. Basel III. Oh, we can't lend to Garbage Corporation? No problem. Check. We got that one covered. Yes, we're following the rules. And then you just peek slightly beneath the hood. And you're like, wait a minute here. You're indirectly lending to Garbage Corporation. Of course they are. Of course they are. And anyone that thinks otherwise or has thought otherwise since the GFC, I think it's like you're kind of like a little kid, like looking at the world through these rose-colored glasses. It's like, whoa, you got to wake up here. It's just naive. It's just naive in my view. Maybe I'm wrong. Moving riskier activities outside the regulated banking perimeter, where failures are backstopped by the FDIC, seemed like a good move. Yeah, it's a great move for the banks to load up on cash. And by the way, another thing that causes this or incentivizes this, let's just say, getting around the regulations, going into a gray area and taking all this risk. That's another thing. You could say, well, George, why on earth would the banks want to do that? I get that they can make a little bit more money, but there's a lot of risk lending to Garbage Corporation. Sure. But they know they're going to get bailed out. They know that because what has happened since the late 1990s? Every single time they get into trouble, what happens? The Fed bails them out. So if you know that you're going to get bailed out, then why would you not take exorbitant risk? And then if the Fed tries to say, okay, we're going to bail you out, but we understand that's creating moral hazard, so we're just going to create a regulation so you can't take more risk. And therefore, we won't have any moral hazard. Again, that is totally naive. It's ridiculous because you created the moral hazard. Therefore, no matter what speed bump you put in front of the banksters, they're going to be one step, they're going to be 10 steps ahead of you, and they're going to find a way around it. We've seen this happen over and over and over and over again, going all the way back to the 1980s. In fact, you could take this all the way back to the 1950s. A prime example of this is Bretton Woods. So the banksters and the PhDs and the economists, they like to sit there and think they're clever. Oh, well, we're going to set up Bretton Woods. And then the banksters are like, okay, well, this sucks because we need dollars outside of the United States and we're not getting enough. So what do? They create their own dollars. So then you've got the Eurodollar system that blows up and becomes the main component of the monetary system. It was just a solution to government regulations. I mean, they get around it every single time. Jeez. I know I say that so I'm blue in the face, but it drives me crazy that people just, it's like if we all pretend that the regulations have teeth, then it's like it makes us feel good or something like that. So we just like to pretend that the Fed does control everything, because if the Fed does control everything, then that fits my narrative and that makes all the pieces of the puzzle fit. But if the Fed doesn't control everything, then none of these pieces of my monetary framework fit together and I've got to reevaluate everything, and that's just too much work. So instead of actually working through how the system works, I'm just going to be like, the Fed controls it, and there's no way the banks have the liquidity, and there's no way they're going to do anything to go around the regulation. And if they do, I'm just shocked by it. As opposed to, for me, that's my base case. So they say the surge in NDFI lending was really because all those different regulations added up to say there are a bunch of loans banks can't make anymore. But if they lend to someone else who does them, that's okay. Hello, right there, right there. Exactly what I'm saying. This, maybe this is a different person. They say NDFI, and again, that's non-depository financial institution. That would be a shadow bank. That would be a private bank. That's basically the workaround for the regulation. Because of the collateral involved, goes back to collateral, typically has a higher loss rate. You don't say. And the losses can come very quickly and out of nowhere. Right. So it's not just the fact that some of these entities can't pay them back. It's the fact that they can't pay them back and the collateral that they used isn't there. It's a fugazi. It's gone. It never existed. And what caused the GFC? Or one of the main catalysts. It's the exact same thing. Is everyone thought that they had all these mortgage-backed securities, and the mortgage-backed securities were used as pristine collateral. And all of a sudden, we wake up one morning, and although the collateral was still there, it's not technically a fugazi, but the collateral, instead of trading at 100 cents on the dollar, it's trading at 10 cents on the dollar. And effectively, that does the exact same thing. So the main takeaway here is, I think what you're seeing in Repo is totally explained by what we're seeing with First Brands, with Zion, with Alliance, and what Jamie Dimon is saying about the cockroaches. Where there's smoke, there's fire. And it's totally consistent with my worldview that A, the banks create money. They don't need bank reserves. It's not a liquidity issue. It's a risk issue. And also with my worldview that these regulations are laughable. They're laughable if you think that they're somehow going to constrain the banks. The banks are always going to find a way around it. And if the Fed and the central planners continue to bail out the banks, we're going to continue to go through this cycle where they take on too much risk, they blow up, and then the taxpayer has to fit the bill, or the Fed has to come in and bail them out. The solution to this problem, or the best path forward, is to do what? Let the banks fail. Let the banks fail. Let the depositors take a haircut. Because then, and only then, are the banks going to be incentivized to not take this crazy amount of risk, because they know that's going to come back and potentially haunt them. They're not going to get bailed out. And if they don't get bailed out, then they're going to go bust. And they don't want to take that risk. So you're applying market forces. I mean, shocker, right? The way forward is through free market capitalism. Not capitalism, notice. Free market capitalism. And the reason I always emphasize free markets is because a free market is absent any type of central planning bailout. And if you really think about all the problems that we have, it's not really a result of QE or artificially low interest rates, blah, 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 blah. It's really a result of the central planners bailing out the system since the late 90s and creating this moral hazard. And then having to create rules in order for the banks to not take advantage of that moral hazard. It's just a crazy treadmill that we're on right now. But it's just so obvious what we need to do. It's so obvious. And then, of course, looking at these other indicators, and I'm just talking about interest rates themselves, I'm talking about oil, I'm talking about the fact that gold is at extremely high levels, at all-time highs, and it's not because of the debasement trade, it's because of the fear trade. It's because of the fear. It's because of the disinflation. It's because of the fear. It's because the system is starting to show a lot of cracks. And that's why you see oil tanking, yields tanking, and gold going straight to the moon. All right, guys, if you want more info on this, or if you want to know how I am setting up my portfolio for financial bubbles, because regardless of your take on your risks or recessions or inflation, deflation, disinflation, I think we can all agree that with the AI bubble, the stock market bubble, the housing bubble, we have all of these financial bubbles. And the question becomes, how do you set up your portfolio? What do you do about it? How do you protect yourself and hopefully even grow wealth in this crazy, crazy environment that we live in that could be extremely volatile, which is what we're starting to see potentially in the repo market? Well, the good news is I'm doing a webinar October 29th where I'm going to be going over 3 strategies, contrarian strategies, that all the pros that I know, that I hang out with in St. Bart's, I've had the opportunity to meet and learn from, they all use these strategies during times where we're in financial bubbles. And they're completely contrarian. I can assure you, if you're doing the old, well, I'm just going to buy and hold, I'm going to buy the dip, I'm just going to take 10% of my paycheck and allocate it to an S&P 500 index fund. If you're doing that, there are no probability, or there are no certainties, there are only probabilities, but there is an extremely high probability that you get crushed, that you get absolutely smoked. And what has worked over the past 40 years most likely will not work moving forward. And I'm going to be going over all of that on this webinar. And the huge bonus there is that if you attend the webinar, you get a coupon code, a $500 coupon code to get a ticket to Rebel Capitalist Live 2026 for $99. You cannot beat that. You cannot beat it. So Josh will put a link in the chat, in the description. You can go register for free. And on that bombshell, guys, enjoy the rest of your afternoon. As always, make sure you're standing up for freedom, liberty, free market capitalism, where we actually allow entities to go bust that make bad decisions. Novel idea, right? See you in the next video.